Welcome to the Delaware Mortgage Rate Weekly Mortgage Market Update for the week of October 6, 2014. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you an update. Well, last week, Delaware mortgage rates ended the week almost about where they started, but they went on a little roller coaster ride. If you take a look at the bond chart on the screen, you can see the short-term trend has changed twice. We were on a downtrend at the beginning of the week, had a nice recovery, and started a short-term upward trend, but then to end the week, sold off after the jobs report, capped out at the level of resistance, hit that, sold down, and the short-term trend is kind of bearish for bonds to sell off. So looking at this, if you look at the chart in the past, every time we've hit this level, bonds have sold off and moved lower, which has moved interest rates higher. So, and the stock market also rallied on Friday on a good jobs report. So with all that in mind, we're going to actually recommend locking in your Delaware mortgage rate to start the week. Take advantage of this nice run higher. We've got some bearish signals for the bond to move lower. Stock market's rallying. So the risk to the downside is much higher than the risk to the upside. So we're going to go ahead and say lock it in. Take the good rate that you have now and just keep it moving. Now, if we look into some economic news, the big report was Friday, which was the release by the Labor Department of the September Jobs Reports 2014. That showed that we created 248,000 jobs for September. That was a big rebound from August's low of 180. They also revised the last 2 months higher by 69,000 jobs. And then we saw the unemployment rate drop down to 5.9%. That was much better than expected. It was only expected to drop to 6.1%. So that was the lowest rate in 6 years. So all in all, the report looked to be like a very good report. But if you dig into the report, not as good as it looks on the surface. The big issue is hourly earnings came in unchanged, which means there's no wage growth. Without wage growth, it'll be very hard for the economy to continue growing any faster than it is. We also saw the labor force participation rate, the LFPR, drop to the lowest it's been since 1978. It dropped to 62.7. Now the LFPR measures the number of people eligible to work 16 years and older that are actually working. So with that number dropping, the number of people actually working dropping, and the unemployment rate dropping, the only plausible explanation for the unemployment rate to drop is not that more people went back to work, but it's that more people are no longer counted in the workforce under the unemployment number. Still counted on the LFPR, that's why it dropped. So all in all, with the stagnant wage growth and LFPR actually dropping, then that means the report overall is not as good as it looks on the surface. So we'll have to keep looking at the labor market to see if we can get some wage growth going. Weekly initial jobless claims, another report that actually came out good, supporting a strong labor market, dropped even lower to 287,000 claims for the week. That was a drop of 8,000 claims from the previous week at 297. And the labor market continues its recovery. So we had two good reports last week, which helped the stock market rally. Good jobs report, good weekly initial claims. Again, that's why we're recommending locking your mortgage rate with the bond market going to probably sell off if the stock market rallies. Now, in housing news, had some good news there. CoreLogic reported that completed foreclosures dropped 22% year over year from August 2013 to August 2014. The nationwide foreclosure inventory fell by nearly 33% from a year ago. The number of homes in the stage of foreclosure dropped from 936,000 in August 2013 to only 629,000 for August 2014. So that's a great report on the foreclosures in homes that are having trouble. And CoreLogic stated at the current rate of foreclosure, the shadow inventory of bank-owned homes could fall below 500,000 units by the end of 2014, which provide a solid boost to the recovery in the housing market. So great news there on housing recovery. And then we saw the Case-Shiller 20-City Home Price Index, which shows the appreciation year over year from July 2013 to July 2014, showed a 6.7% increase. So that's a good, solid number. That's above the historical average of 5 to 6%, but it's actually a drop from June's year over year. June 2013 to June 2014 was 8.1%. So it does show the rate of appreciation nationwide is slowing, but it's dropping to a more manageable level that we can keep consistent year over year. Can't keep those high numbers. So it's actually a good report there. In the local news, the next free first-time homebuyer seminar is in Dover, Delaware, which is this Saturday, October 11th from 10 a.m. to noon at the Dover Holiday Inn. And then the next one in Newark is Saturday, October 18th from 10 a.m. to noon at the Christiana Hilton Hotel. You can register either one of those events by giving us a call in the office, 302-703-0727, or online, www.delawarehomebuyersseminar.com. Look forward to seeing you guys next week.